The results for the infrastructure bond are out, and apparently the government had to reject 63 billion worth of the bids. Let me explain. Now, initially, the government wanted to raise 70 billion from these two bonds. Only 70 billion, which of course is going to be used for infrastructural projects, building roads, building dams, and any infrastructure related project. But apparently, when you look at these two bonds based on the results, you're going to notice that with the first bond, the one that was for, I think, 11.8 years, this one, it was for 11.8 years, that was offering an interest rate of 13.93%, 93 billion worth of bids was placed. But eventually the government had to end up accepting 65 billion. So part of this was not accepted. It's the same for this other bond. This bond was going for, I think it was 15.1 years. So with this bond, it was giving at least a higher interest rate, a higher coupon rate than the first one. Maybe that's why it had like a lot of bids, because you'll notice that with this bond, 100 billion worth of an investment was to be made here based on the market. But eventually the government had to accept 65 billion. So there's a difference here that was rejected. The total sum of bids that were placed was around 193 billion. The government accepted 130 billion, which is higher than the 70 billion that they were aiming for. And around 63 billion was rejected. So some of the investors, probably it's you, yours was not accepted if it did not meet the criteria. So why would the government not accept this 63 billion? Let me explain. Is this rate known as the market weighted average rate? So think about it this way. Ivy wants to invest 5 million and she wants to place a bond, and she wants to place a bid. James has 2 million, she wants to place a bid. Mark has 12 million and he wants to place a bid. So we have different people who are trying to place bids to decide, or rather to express how much they want to pay for the bond. Remember, when you compare all those people who have the privilege of choosing their price or expressing the price of the bond that they want to pay, that rate was 14.08%. That is the mean average based on the number of people that wanted to buy this bond. For this other bond, the one for 15.1 years, the rate is 14.41%. I want to show you something. The higher the rate, the higher this rate, the lower the price of the bond. There's that inverse relationship. So I'll give an example of, let me use 10 million. 10 million is preferable. So you have 10 million and you're trying to place a bid here on this bond. So the higher the rate, if it's 15%, you're going to pay around, let's say, 9.8 million for this bond. If the rate is going to be 18%, this number keeps on getting lower. You're going to pay 9.5 million. If you place something like, which is impossible, 20%, you're going to pay something like 9 million. So that's what the guys who have that privilege of placing a competitive bid do. The higher the rate, the lower the price of the bond. You'll notice that the rate for the second bond was a little bit higher, so people wanted to pay less for this bond using this analogy of 10 million. So this is just what the market was willing to pay. We also have this metric known as the weighted average rate of accepted bids. This is what eventually the government said, okay, we only accept this this percentage. So remember, now that the rate has gone down, you have to pay higher. So if it's 13.9%, this time you're going to pay, it's still at a discount because it's still more than 13.9% is still more than this, so it's going to be around 99. So here you're going to pay something like 9.9M. So the weighted average return of accepted bids is what the government finally accepted, and it's weighted. So this is the average. It's not specific to one person, but it's going to be different. It can be 13.87, it can be 14, it can be 13.91, it can be 30, so around that. And this is just the weighted. So this is the average that somebody who doesn't have the right to place a bid, or rather a competitive bid, somebody who invests, let's say 100K, 50K, is going to get this. It's the same for these other guys. You're going to notice something. If this is what the government accepted to give non-competitive bidders, people who placed their bid like 100K, 500K and such, when you compare this rate, this is the yield to maturity rate. It's the market rate that has been accepted by the government. So the government gave us 13.93, but the market determined that it's 13.97. Since this rate is higher than this rate, this bond was sold at a discount. At a discount means you paid a lower price for it than the normal 100K. So assuming that you invested 10 million, in this case, you're going to pay, let's say 9.8 million. This is what a discount means. So for this first bond, it was sold at a discount, at a lower price than the value of that bond. The second bond was sold at a premium. At a premium means you paid a higher price for that bond than the actual price should be. So assuming that the price of the bond is 10 million, you wanted to invest 10 million. If you bought this bond, which is going at a premium, because this 14.28% is less than what the government gave us. The government gave us 14.39. So you can see the difference. This is 0.39, this is 0.28. So the market gave us a lower rate. Remember, the lower the rate, the higher the price of the bond. So since this is less than what the government gave us, people are going to pay a premium price. It actually means that the demand for this bond was more. That's what it takes. Because remember, at the end of the day, when you're doing a bidding process, let's even take an example of people going to the market to buy a sack of potatoes. There's this one sack of potatoes, and somebody is like, okay, I want to buy this sack of potatoes that is actually worth 100K. I want to buy it at 200K. Then somebody says, you know what? No, I'm going to pay this sack of potatoes for 500K. Somebody says, no. Okay, I can only accept 150K. Remember, the value of this sack of potato is 100K. So somebody is willing to pay the normal 100K. Somebody is willing to pay a higher price, which is 500K, and somebody is willing to even pay a lower price, which is around 90K. Remember, this is competition. And it's all based on the forces of demand and supply. The supply is limited, we knew the government was looking for 70 billion, but there's high demand for these two bonds. So what happens? People are willing to pay a higher price for that bond because this bond is so precious. That's the case here. People are willing to pay a higher price than the actual value of the bond because of the interest that they were expressing. So this was sold at a premium. By the look of these two metrics, you can be able to see that people were willing to give the government 193 billion. The government wanted to accept 70 billion, but they were like, okay, they were a little bit lenient. They accepted 130 billion. So eventually 63 billion had to be dropped. These two bonds were on high demand. Remember, you don't pay taxes for these two bonds. These are the icing in the cake. Yes, we normally have bonds listed every single month, but these ones are just precious. So that could be the reason why there's not much difference, or rather the price was high. I want to show you one last thing, because you might be asking, Ivy, I invested 100K, but I ended up paying a higher price for it. I didn't pay 100K, I paid more than that. Now, remember, this was the rate that the government gave us. It's like the mean average rate. So if you invested, let's say 100K, you wanted to invest only 100,000 Kenyan shillings worth of value. This is the amount of money that you're going to get back after the 6 years lapse, 100K. Or you already know that this is how much you're going to be making every single year. And the rate that has come out, what the government is offering, the average rate is 13.97. 13.97 is less than what the government gave us. So the government has to compensate us by giving us a lower price, which ended up to be given at a discount. So when you punch in the numbers, when you use the calculator, I did this on the back end, you're going to notice that for every 100 shilling that you're going to invest, you're going to pay 99.7487. So this is a discount. This is what we mean by a discount. You didn't pay the 100 shillings, but you paid the 99.74. So it was offered at a discount. Remember, there was that concept of accrued interest, which is here, that was listed earlier on when these bonds were being listed. And according to that, for every 100 shilling that you are to invest here, you are to pay this interest, accrued interest of 3.75. So this is what we call the clean price, the actual price that you're supposed to pay. But if the bond is being reopened and there's some interest that you don't deserve, that's how I define accrued interest, it's going to be added to the clean price. So now the price that you're supposed to pay is not clean anymore, it's dirty. So we have to add this plus this, you get 103.501. What this means is that if you are to invest 100,000 Kenyan shillings, for every 100 shilling, you have to pay 103.501. What about if you invest 100,000 Kenyan shillings? How much will you do? So you just cross multiply this, and this times this, divide by this, and you're going to get, let me just write it here, 100,000, 103,501. For somebody who invested 100,000 Kenyan shillings, they paid 103,501. It's the same thing for this other bond. This is the clean price. This is the price that you're supposed to pay based on the two rates, the coupon rate, that is the interest that you're going to be getting every single year, and the market rate that has been set out, which is the yield to maturity. Just call it yield to maturity. Remember, this is less than this, so the price goes up. By that we mean for 100 shillings, you're paying 100 shilling 0.615. There's this additional 0.615. So this is the clean price. This is ideally what you're supposed to pay. But because this is a reopened bond and there's the concept of interest that you don't deserve, accrued interest, when you add that up, you're going to get a dirty price. That is the final price that you're supposed to pay of 106,984. So if you invested 100,000 Kenyan shillings using this mathematical formula, you are going to give the government 106,984. And when the time lapses, when your bond has matured, you're going to get back 100,000 Kenyan shillings. I'm curious to know, one, was your bond part of this 63 billion statistic, which is the rejected bond, the rejected bid? And two, of the two, which one did you invest in? I'm just curious to know why. Because I noticed most people were going for this bond because it was offering a higher coupon rate than this. And people really care about the interest that they're going to be making every year. Perhaps that's why it was sold at a premium, because it was on high demand. Yeah. So which of the two did you invest in, or do you regret investing in either of the two? Thank you for watching. Like this video and see you in the next one.